Hi, I'm Marcos Casarin, Chief Economist for Latin America at Oxford Economics. Today, we're going to turn our attention to Brazil. Latin America's largest economy just reported stronger than expected growth numbers in Q1, and last week, the lower house of Congress voted to approve a new fiscal rule. The bill now goes to the Senate. We still forecast 4 consecutive years of primary deficits and the debt to GDP to reach 86% of GDP by 2026, which is essentially a return to the peak reached during the worst days of the pandemic in 2020. On the inflation front, headline CPI continues to fall and should dip below 4% in May and June, helped by base effects from last year. We forecast headline CPI will close this year just above 5%. We continue to see the central bank cutting rates before the Fed. Our call is for a first rate cut in November. Importantly, we forecast 400 basis points in rate cuts next year, which looks aggressive, but it's actually a relatively conservative easing cycle with 50 basis points in cuts per meeting throughout 2024. On the currency front, the real has been one of the best performing EM currencies last year and also this year, having gained another 7% against the dollar year to date. At 4.96 against the dollar, the real is very close to our fair value zone for the year, which is around 5.01 and 5.06. So unless we expect another bout of dollar strengthening, we don't think the real should have much downside from here. Local currency bonds rallied significantly after the Fed pivot. So on the valuation side of things, we don't find either local currency bonds or FX particularly cheap. That said, with no imminent risks of about to brew domestically, we think there should be more to come in this rally. Accordingly, we have recently upgraded Brazil's local currency bonds to overweight in our asset allocation matrix, as the curve should uninvert in the next 12 to 18 months as the BCB unwinds its massively restrictive policy stance. So what's not to like then? I think there is a big disconnect between what markets think and what economists think inflation will be in the medium term. Break-evens point to inflation between 5 and 6% in the coming years, but inflation target is close to 3%. Our forecast is somewhere in the middle, with average inflation close to 4.5% in the next 4 years. The key reason for the disconnect is the growing expectation that the central bank policy will change once current Governor Campos Neto leaves the BCB at the end of 2024. With a board that is supposedly more aligned with Lula's ideology from the end of next year onwards, we see a non-negligible risk of Brazil trying once again the 2012 experiment of implicitly pursuing a higher inflation target and ease monetary policy to let domestic demand overheat ahead of the 2026 elections, just like what happened in 2014. That said, most of these sources of risks are 2024 stories, and in 2023, Brazil's growth has surprised to the upside and inflation has declined steadily. And while the new fiscal rule is worse than the spending cap that preceded it, we think investors have good reason to turn a blind eye to debt sustainability risks for now and enjoy the BCB's rate cuts. Thank you.